Hey everybody, it's Erik Torenberg, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Venture Stories by Village Global. I'm here today with two very special guests to talk about insurance. Karn Saroya, founder and CEO of Cover, who I'm lucky to be an investor, and Sheel Mohnot, investor in FinTech and insurance, who I'm lucky enough to be a friend. Guys, welcome to the podcast.
Yeah, thanks for having us.
Karn, why don't you tell the audience what is Cover and why'd you start it?
Sure. So Cover is a multi-line national insurance entity. Our customers take pictures and videos of things they want to insure using our mobile apps, and we get them insurance. So we are a marketplace for risk, operate in 49 states, work with 30 different carrier partners, and are standing up some of our own insurance products simultaneously.
How did you navigate the idea maze that is any company you could have started in insurance?
Yeah. So, myself and my co-founders have been building consumer-facing products, specifically native mobile products, for a number of years now. Prior to Cover, we built a company called StyleKick, which sold high-end fashion on the internet. It's a native mobile app. Grew that to about 1 million active users. That was featured in 80 countries on the front page of the App Store, translated into 14 languages. So we got very good at building sexy consumer-facing experiences and finding significant distribution for them. And so that company ended up joining Shopify. And while we were at Shopify running a mobile product team, we were exploring a variety of different verticals that we thought we would want to build into. We knew we wanted to build a consumer-facing product. We knew that we wanted to do native mobile again. So we built things in healthcare, again, in entertainment. Insurance really resonated with us. Outside of my insurance expertise, prior to tech, I was a management consultant at Oliver Wyman. The basic economic model makes tons of sense for us. It's a business with consumer scale, but best in class SaaS type economics. And that was really what drew us to the space.
And how did the idea evolve since starting Cover?
Yeah. So when we first started, we joined Y Combinator, basically the idea stage. And all we wanted to do was prove that we could drive significant distribution, via our apps. And we did that. We ended up, on the front page of the App Store within a couple of weeks of having joined YC, driving tens of thousands of new customers a day, and, could show that we could build a sizable insurance business. So we started as a lead gen business, quickly realized that selling leads, is a kind of a scummy business. And so, you can't translate that into the lasting type of brand value you need to build around yourself to build a sustainable insurance business. And so we eventually stood up a national insurance brokerage, I think in record time, across the country, picking up 30 carrier appointments, in just under a year. And now we're moving a little bit further and standing up some of our own products. So the arc is being pure distribution, moving towards underwriting.
Sheel, you're an entrepreneur, investor, been in FinTech for a long time. How have you thought about insurance and opportunities therein, and how has that evolved over time?
Actually, so let's talk about how it's evolved, because what's interesting is just like a few years ago, there wasn't that much going on in InsureTech. Like this whole word I never heard of 3 years ago, and now there's a conference with thousands of attendees. So I think like if you looked at like sort of 3 or 4 years ago, I can't think of what were the insurance companies at that time. I guess like there were health insurance companies. So like Oscar had already started.
Yeah. On the property side, there were legacy folks like CoverHound.
Yeah.
It's the most notable. Zebra, which...
Zebra started, 6 years ago.
Yeah. And they, I think they started again as lead gen and eventually a broker. Now they're a hybrid of that. But it's a pretty nascent space.
Like all of these MGAs, managing general agents, like there were managing general agents have been around for a long time, but these startups using an MGA to basically jumpstart their activity really I started seeing them 3 years ago. And now in every category in insurance, it seems like we have multiple startups. Like I think we could probably name, like in life, I could think of like Ethos, Fabric, Ladder. Mm-hmm. What am I missing? Anyway, there's a bunch, right? Like in any category, home, so P&C, life, like every category, there are a bunch of different players. Most of them are really digital distribution of a similar product to what you could get elsewhere. What you could get elsewhere though really sucks. Like if you've ever had to buy insurance it's a pretty miserable process. For my house in San Francisco, when I bought insurance 4 years ago, it took me like hours of time on the phone to get insured. And that actually hasn't changed that much. And if you think about like how other industries have digitized over time, it actually is shocking that in insurance, most people still use brokers. So like, I think in auto, it's something like 60% of people still use brokers. Or agents rather. 60% of people still use agents. In homeowners, it's over 90% still use agents. In commercial, it's nearly 100% use agents. So like agents in other parts of our lives, like travel, for example, have been completely disintermediated almost. And it doesn't necessarily make sense that they have not been in insurance. So I think people saw this opportunity like, oh, there's a ton of huge insurance companies. Buying insurance is terrible. And the people coming of age, especially coming of age in mobile, like are now having to buy insurance. And that's why like cover makes sense. So people a few years ago saw these opportunities, and now very quickly in the last 3 years, there's been a massive amount of coverage, and there are startups in nearly every sector. And if you have to break them down, there's a few different ways you can break them down. You could say like P&C, which is property and casualty, which is like homeowners, auto that goes under there. There's life insurance, health insurance, and then commercial insurance are probably like the broad categories. You could also break it down into how they're distributing. So there are companies that are just digital distribution of the same product. They could be a agent. They could be a broker. They could be what's called a managing general agent, which gives you somewhat the appearance of being your own insurance company as a carrier, but without the large amount of pool of reserves you need to have. You actually have a reinsurance company behind you that actually is doing all of the risk taking. And then you could be a carrier. Not many companies have gone the carrier route. It requires a large pool of capital. And also historically, like we know how carriers trade, and like they trade on their book, and it tends to be not great valuations because they're so capital intensive.
And which is why actually you see most startups who have gone the carrier route cede risk, like the vast majority of their risk, to reinsurance panels anyways. So they're acting as MGAs, but with the admitted paper.
Yeah, I mean, and speaking of paper, I don't know if we want to go into like the details of like
please.
Reinsurance.
Please, let's give
paper.
a primer.
So I don't know, Karn, you want to go?
Yeah. So, I mean, let's just extend the idea. The reinsurers are probably acting as the most sophisticated players in this space. And so you see folks like Munich actively investing, across the value chain, both providing reinsurance capacity as well as paper. So this means that, folks who are, relatively sophisticated distributors of insurance can rely on these folks now, to be for support designing, and actually backing some of these products. It's been an interesting, couple of years in that you've seen most InsureTechs who are not just directly distributing insurance as brokers almost leapfrog primaries entirely.
Yeah.
That's been one of the interesting consequences of at least what I've seen over the course of the last 2 years. And then reinsurance brokers, similarly, the folks who are helping to place reinsurance risk, with the reinsurance carriers have also, I think, been somewhat disintermediated in this wave.
Yeah.
That's what I've been seeing.
Sort of one thing I actually thought about, just based on what I said earlier about like how everyone's still using agents. Mm-hmm. It's actually not everybody. Like I said, in auto, it's like 60 to 70%. And the companies that went direct only went direct in the past 20 years. And they're companies that everyone's heard of, Geico and Progressive. Those companies have done incredibly well. And they went direct like in the mid to late 90s. And Geico was a nobody at that time. And now they're probably number 2 after Allstate in auto. And so going direct has been incredible for these companies. Yet all of these other insurance companies are not going direct. Isn't that weird?
Yes. Why not?
I mean, there are a couple of reasons for that, right? The first is that for these folks that distribute through independent agents, it's defined CAC business, right? They know exactly what they pay agents. And so if you know exactly what you pay, you know what the LTV of that customer is, you can do the backwards math and make it make sense for you.
And that's their customer. Their customer is not you, the end customer. They're selling to their agents, either captive or not.
Yeah. It gives them a footprint on the ground. It gives them easy visibility in local neighborhoods. But I mean, if you want to contrast that with the example of Geico, Geico is very happy running hot, so it can squeeze its expense ratio.
Yeah.
The expense ratio component, of that economic model typically will incorporate the cost of.
Oh, let's talk about expense ratio or loss ratio. You want to?
Sure. So let's talk about property and casualty as a stylized example, right? Geico, Progressive, these guys are going to be running in the 70s across their auto book of business. They're trying to keep their.
No, sorry. Why don't we explain?
What is a loss ratio?
Yeah.
So think of it this way: you give me $1, and I give you 70 cents back in perpetuity. That's a loss ratio. So it's like, what is the proportion of the dollar that you pay into via premium that's paid out in claims? The rest.
So the example would be like you spend $1,000 a year on your auto, let's say, and then so what he's saying is your loss ratio is the claims that they pay out on your behalf. So 70 cents of that is used to pay off claims, and then there's administrative overhead, which is then combined to be what's called a combined ratio.
Right. So LAE and other operating expenses are going to take you to about $1 or to par, generally speaking.
So most people are surprised by this, but insurance companies generally don't actually make money on that side of the business. Like the insurance companies exist to gather a large pool of capital, and then they invest that capital, and that's actually how they make money.
Yeah. So if you're a carrier, this is more like a float maximization problem, right? It's like, how much cash can you get flowing through your business, and then can you invest it and lever it? That's effectively the business, which is actually very different from what most startups are doing at this point, which is they are either trying to make money on distribution, or they're trying to make money by squeezing out a couple of points of margin on the underwriting side. That's their ultimate goal as it stands. But when they're writing $20 billion of business a year, the actual model starts to change to, hey, we can start to continuously lower our prices, squeeze our expenses, run at nearly 100, where, every single dollar is being eaten up by either claims or operating expenses and maximize float. That's a typical model, which is actually why, insurance companies don't have the multiples, as Sheel alluded to, that make them super attractive.
But that does mean that there's an opportunity because there's such low margin businesses. They're actually no margin businesses that if you can save them a point or two, there's an opportunity. That's a big lever for them.
Maybe it might be helpful to go through each of the different subsectors, talk about how they work, what are the challenges to building a company in the space, and what are the sort of the opportunities or white space or approach that one might take if they're trying to build a company in one of the spaces.
Yeah, sure. So I'm happy to take you through the arc of brokers, MGAs, carriers. So, brokers are folks who are selling, other people's insurance, right? And so you'd be working with Progressive, Safeco's, Travelers of the world. And that is appealing because, it's a defined economics business. You know exactly what you're making as a percentage of dollars that you pull in, and it's in perpetuity. You own the business. So say I were to sell a Progressive policy to you, I'd make anywhere from 10 to 15% of that policy in perpetuity for the life of the business. I don't take any balance sheet risk. There aren't really any repercussions or material repercussions for me. Should you be a bad risk? If I keep writing bad business, I eventually don't sell Progressive. That's the extent of, the challenges that brokers have with dependencies on incumbent carriers. So if you move upstream of that, Sheel alluded to managing general agents. And so the way that's structured is you can design the insurance product. You can file the insurance product using something called a fronting carrier. And so these carriers exist for the purpose of renting out a license effectively. So they charge anywhere between 3 and 5% of underlying premiums, which is such a stupid business.
It's just a regulatory play. It's so silly.
So there are a fair number of these guys, and they've, kind of come in vogue with this InsureTech wave because they typically speaking weren't, utilized to the extent that they are. They can have a couple of programs per state.
You say there's a fair number, but actually there aren't enough. So now with these new companies, because you can only, in a particular state, you can only sell one type of.
Right. Yeah. You can have 2 auto programs or 1 home program. And so, there have been a fair number actually that are being spun up now because they're fee earning businesses, right?
Yeah. They're not going to be venture scale businesses.
Yeah, for example, State National was purchased by Markel for $900 million, and it charges 5%. It takes no risk. It charges 5%. So anyways, startups will contract out with these fronting carriers for simply the right to sell insurance in a given state. And so insurance is regulated on a state by state basis. You got to do this in every state, unless that carrier has a license in every state. And if Sheel alluded to, if you're not taking balance sheet risk, you need to somehow find somebody who will take the risk on all the products that you write. So if you're writing a homeowner's product like Hippo, or a renter's product like Lemonade, you don't want to be raising the capital. Like you certainly don't want to be raising venture capital to fund anything outside of, operating losses while you grow. You don't want to be holding the funds you raise via venture, for regulatory purposes to the extent you don't have to. And so, they'll go out to the reinsurance market. They work with the Munich Re's, Swiss Re's, Odyssey's, Partner Re's of the world, who are effectively just very large pools of capital, and contract out with them to take on all the risk. And so they'll absorb the losses. The startup that collects the premium will pass on part of that premium and again earn defined economics, generally speaking. If they outperform, they can earn more. If they underperform, there may be a slide down. And then the reinsurers themselves, we ignored reinsurance brokers because they're not really meaningful to this conversation. But the reinsurers themselves, if they have concentrated positions, may, go on and sell that risk further. So you have folks that you can retrocession. So you have retros. Then you have folks like Ledger who are making a market for things like insurance, like securities that tie this all together into capital markets. So it's it's this crazy ass chain. It's potentially lead gen brokers, wholesale brokers, MGAs and carriers, reinsurance brokers, reinsurers, retros. There's like 7 different bodies on the take between somebody trying to sell a dollar risk and somebody trying to buy a dollar risk.
Does it need to be so complicated?
It really doesn't. If you boil it down to effectively what it is, these guys are white collar bookies, right? They're taking bets on, what they think will outperform. And so if you boil it down further, it's really just a prediction market.
It's
right?
totally a prediction market.
And so, if that's how you view it, eventually, each of these individual bodies that were created, largely as checks and balances, to make sure that rates were adequate and people weren't being discriminated against across the insurance value chain, you will come up with a very efficient mechanism at some point or another that matches a dollar risk being sold and one being bought. That will just happen. Yeah. It doesn't bode well for the entire insurance value chain, but for real, you don't need 7 bodies taking a slice of every dollar.
If you look at insurance historically, it wasn't this complicated, right? It was the Greeks were originally pulling capital together in their village to make sure that people were protected. And then a long time later in London, there was Lloyd's, and Lloyd's was insuring ships at his cafe, and then it became Lloyd's of London, which now insures everything. I think one of the things that's interesting about what Karn said is talking about how it relates to prediction marketplaces. And that's really, really what it is if you boil it down to it. And there are all these companies. I think one sector that is potentially interesting is, it's called parametric insurance. So parametric insurance just means I'll insure you around a defined parameter. So for example, let's use crop insurance. Your farm is in this particular place. If it doesn't rain X amount of inches during this amount of time, we'll have that from satellite data. If it doesn't rain, you get paid automatically. And what's nice about it is there's no admin, there's no overhead. It's just a parameter and then it gets applied. So it's very much like a prediction marketplace. You just have to be betting on whether that thing is going to happen or not. I just saw this recently. Do you guys know Augur, the blockchain?
Yeah.
So I always thought a blockchain based solution could make sense. I haven't seen a company that's tried to do this that was actually I could get behind enough to invest in, but there seems to be an opportunity there. But with Augur specifically, I don't know if you guys saw this, but there was a betting marketplace on the election, on this most recent election. Did you guys see this?
No.
I'm a legacy InTrade user, so I'm very familiar with this. But
okay. So what happened was there was a prediction marketplace, and I think it said, or will the Democrats control the House after the November 2018 election? It ended last week, and the Democrats do not control the House right now. Now, the intent of the prediction was to say, will they control the House in January when it turns over? But as of right now, they don't control the House. So as a parametric deal, they don't control the House right now. And so it's basically garbage in, garbage out. As the setup was poor, the outcome was poor.
Right. How do you think blockchain or blockchain related projects can disrupt insurance?
Talking to some of my reinsurer buddies, like parametric is probably the first place that this is going to happen. It's certainly not going to happen in admitted insurance markets. So there's a distinction between admitted and non-admitted insurance. Admitted markets are where you're regulated, by like a sovereign effectively. So it's either a country, depending on which country you are, or the state if you're in the United States. And there's just no chance that, this is not like Uber or Lyft where you have a huge balance sheet, you enter the market and you compete with the municipality, you just take them to court. The state will put you in an orange jumpsuit. You're not going to be able to win in admitted markets where it's regulated at the state level, but you probably can win or start designing something in something called the surplus lines or the non-admitted market. And so, let's talk about surplus lines. It's like Lloyd's. We're talking about really idiosyncratic risks. You're trying to insure an oil tanker against some sort of spillage.
Or they famously insured J-Lo's ass.
Yeah, stuff like that. That wouldn't otherwise fit neatly inside of a easily measurable box. And generally speaking, this kind of stuff falls well outside the scope of, the regulatory frameworks that exist in the United States or the UK, Australia. That's likely where it's going to happen, largely because you can operate in the gray area, when it comes to those markets.
Yeah. I think there's a tremendous amount of opportunity internationally. Like, as we saw in like lending, for example. So like in lending in the US, there aren't that many opportunities to innovate because there's like Fair Credit Reporting Act and all these things that regulate how you can underwrite somebody for their loan. In Africa and lots of Asia, none of that exists. So you can do all sorts of cool stuff, with data that you can't do in insurance. And I think the same is true with this stuff. Like, there's a lot of opportunity internationally that there is not here.
So let's go through some of the sectors you mentioned earlier when you talked about car, auto, home, P&C, like opportunity. How do those spaces work? What are the opportunities there?
Yeah, sure.
Examples of companies you like.
So let's say like one I don't like, I typically have not liked, and I don't know, maybe Karn will disagree with me. Like, I've never liked renters insurance as a category. And Lemonade is obviously a huge company, like actually tremendous innovation on product side there.
But it's not huge.
It is. Well, they have innovated both on the insurance side and on the to consumer side.
Yeah. I think they have. One of the things that InsureTechs have done really well is they continue to deliver on the product and consumer experience.
Yes.
Right? Like, I think over time, great product teams will craft great product experiences, and, all of the nonsense, the block and tackle stuff that insurance companies do terribly will go away. In lieu of what folks like us build. But I agree completely with you. Renters as a business makes no sense unless it's, but let's think about it this way, right? Like, you charge $6 a month or $7 a month for insurance. You earn 20% of that before interchange fees. So you're earning maybe $1 per month, $12 a year, and your CAC is hundreds of dollars. Your payback period is forever. Like, you're just never going to be able to make the math work unless you take the longer view, which is a possibility, which is
sell other stuff.
Yeah, sell other stuff. But that's the playbook for every financial services company that's ever existed.
Yeah.
Right. Yeah. So renters, I agree with you.
So renters, I never understood these companies that started renters insurance companies, or these folks that fund them, whatever. It never made sense to me. I think every other category I actually think is interesting. Yeah. And renters is just like the dollar amounts are too low. Life is a particularly interesting one. Like, we've had, first of all, far fewer people get life insurance than did in the past, which generally means it's like less appealing. But in this case, a lot of the life insurance companies are actually trying to do something else and then tack on life and find you at the right time. It's all about finding you at the right time. And one in my portfolio that I think is really interesting is it's called Mira Financial. They work with diabetics. They take existing life insurers. When a diabetic comes in the door, they have a really tough time underwriting diabetics. So they oftentimes won't. And they'll say, like, you can't get insurance through us, or you have to fill out 40 more pages of crap. So Mira says, hey, we'll take these diabetics. We'll put them on a plan that, like, they have to wear a wearable and a few other things like that. And we can underwrite whether their diabetes is controlled or not based on that. So it's actually a new product in life. I like that. There's another company called Health IQ that's doing something very similar. But actually, Health IQ started out so Mira is underwriting people who are perceived to be sick, but actually better than they're perceived to be. Health IQ is saying, we'll go after vegans. They're like a really good risk. So they're going after like ultra premium risk. And so Mira is actually the opposite, but now Health IQ is going after that sector too. So anyway, life insurance, interesting sector. Homeowners is an interesting sector as well. I think in many markets, it's heavily competitive. In some markets, it's not at all. So coastal areas have had a lot of trouble, especially in recent years. Like Texas and Florida in particular have gotten hammered with hurricanes in the last couple of years. California has had these fires this year, and that is going to be a big opportunity actually for companies in California, because whenever you have a claim, you sort of reassess which insurer you're going with. And also now all these companies will refile rates for next year. So there's actually an opportunity in homeowners that's larger than it was in years past.
Yeah, this actually speaks like to a broader theme. Like the insurance companies of the past that have grown to like considerable size, you know, some have attempted to like underprice a commoditized market and then pick up market share, and that rarely ever works. It's like you blow yourself up in lending, you can blow yourself up in insurance, but it's really in high risk scenarios. So for example, homeowners, you know, being completely repriced because of catastrophic risks. You're going to see a bunch of these existing insurance companies pull out of markets like California, and then an opportunity open up for folks who have some sort of edge to be able to price and pick up tons of market share. Happens in every vertical, actually. So, which is why I like Mira, right? It's like, hey, if a traditional insurance company is not willing to write it, well, the risk has a price. So, and if you're willing to do the work to figure out what that price is, you can pick up the market.
Right? And like in Florida, for example, like after the hurricanes, I think this year, something insane. It's like over 10% of people in Florida got like, we're not renewing your insurance notice. Mm-hmm. Like imagine how devastating that is if you're just like, and you have to give like a 90-day notice. So like in 90 days, all these people won't have insurance. So like anybody who can get them insurance can make a lot of money.
Wow.
Yeah. And they can basically name their price, right?
Yeah, exactly.
At that point. Which is not all that different. Like it happens everywhere. It happened in auto insurance too. Progressive built itself up, by writing high risk, right? Yeah. And so they're like one of the things that they're famous for is writing DUIs, right? So the insight that they had was a single DUI might be a mistake and we'll write it, but 2 DUIs, that's a pattern, right?
And like, if you can find these patterns, that's where the opportunity is. So like Karn said, like that's what it was for Progressive. And like, it's actually like the same business as like Capital One in lending. That's what Capital One did in lending. And that's what Progressive did in insurance.
So who's the Geico and Progressive of today? I mean, what are some of the most exciting, inspiring companies in insurance that you think 20 years from now will be?
So I think the closest to Geico would be ClearCover.
Yeah, I mean, yeah, clear. So Kyle, super sharp guy, you know, emulating Geico in a number of ways, entirely direct to consumer, digital distribution. I mean, Root is emulating, I think, Progressive, but they have like they have like this random factor that they apply that's causing them to lose a lot of money.
So what he's talking about is when you sign up to get insurance through Root, they actually like give you like a test. So they like follow you driving for a couple of weeks and then assess your risk based off of that. So it's like a new insurance product. And my hunch is that it must just crush conversion.
Well, they're inversely related. So the lower your price, the higher your conversion, the lower your cost of acquisition. The challenge with that business is like, there's this huge adverse selection bias to like, if you're willing to wait a month for a quote, like, there's a certain type of customer that is willing to do that, and they tend to be super high risk, which is not a bad thing. Again, if you price correctly for them.
But then
it's tough to
they have their monitoring your driving thing. So like, so you're saying, if I understand it, you're saying that these high risk customers are behaving well during that month, and then it's going to misbehave?
It's not just that, right?
Okay.
Generally speaking, people think of insurance as a nuisance, right?
Yeah.
So if you're now catering towards folks who are willing to put up with it for a month, there's an adverse.
But I think what they would say is actually like a great customer. Mm-hmm. It's no sweat off their back. Like they're already insured. They can have this running in their car and see if they can get a better deal. Yeah. So like they also have the cream. They have a great customer base as well.
Fair enough. But if you take a look at their reviews, it's like I had multiple DUIs and multiple and Root came in and cut price.
Cool. I haven't looked at the reviews. That makes sense.
Yeah. So like there's that, which is a challenge. I think eventually, look, like they're another classic example, I think, of a good product company. Like they're delivering on the experience. The nice part about all of this is like they have enough time to recalibrate, right?
And a shitload of money.
Yeah, exactly.
What are some of the other sort of unicorns in the space? We talked about Oscar, that's in health insurance. Obviously, there's Metromile. I don't know if it's a unicorn, but what are some of the biggest companies?
Yeah. In auto, the companies are just like Metromile, ClearCover, Root. Root actually is a unicorn now, which is crazy. Didn't exist a couple years ago. In homeowners, there's Lemonade, Hippo, and Kin.
Yeah. And there are a couple of others popping up that are focused on coastal states, but I think like Hippo is doing exceptionally well.
Yeah.
Kin I know less about. Lemonade I think is still focused on renters.
No, they do homeowners and
they do, but it's a very small part of their book.
But I think it's just like they're advertising everywhere. And
$5 renters insurance.
And so homeowners is a small part of their book, but I mean the goal is for them to do more homeowners.
Yeah.
And what separates these companies? Is it distribution strategy? Is it product? What is it?
Yeah, I mean, it's a mix of all of these things. Like Hippo will distribute, it has its own direct to consumer, I guess, business, but it distributes through traditional agents as well. Lemonade is ardently, direct to consumer only, will not distribute through brokers, but they do have, these things like marketing affiliate agreements with folks who run HOAs, things like that. Yeah, ClearCover will distribute through folks like us. So we sell ClearCover, for example, but not through traditional brokers. Yeah.
And so ClearCover is like the Geico, which is like low cost leader. Have you found it to be the case? Like, are they cleaning up in the markets that they're in with you guys?
So they're very competitive. There's no doubt about that. It's still very early days.
Yeah, of course.
I have a lot of faith in that team. To be able to figure it out, but it's way too early to be able to tell. Like they haven't had a book season over a reasonable period of time yet.
So let's say we were running a VC fund solely focused on companies in insurance, either directly or peripherally involved. Karn, what would be your thesis? Yeah.
So the thing that I would look for, and actually I don't see very much of in InsureTech is, does a basic economic model make sense, or is it close yet? And so you need to do two things to survive as an insurance entity. The first is be able to acquire good risks at a reasonable cost. And again, that reasonable cost scales with whatever your anticipated premium looks like. So if it's a $5 renter's policy, you can't pay that much to acquire. If it's an $1,800 auto policy, you can pay a little bit more. If it's a home in a cat state and it's $1,000 to $2,000, you can acquire for quite a bit. So you have to be able to acquire good risks at reasonable cost. And you have to be able to underwrite those risks to a profit. To survive in the long run.
So Karn's saying you want a company that can make money.
Correct.
He would like to invest in companies that can make money.
And you're not seeing a lot of it.
Well, it's challenging, right? Like you take a look at the CACs, they're astronomical. You take a look at the loss runs, again, they're astronomical, right? Like it's not like you can take corrective action immediately. There are states that will limit your ability to raise prices. So in California, let's say you're running at 150% loss ratio. That's you're putting out $1.50 in claims for every dollar premium you're pulling in. The max rate hike you could take is 8%, on every renewal cycle. It's going to take you years before you can break even, right? And so there is no acceptable CAC for somebody that you cannot underwrite at a profit for. So the goal, as for any insurance company, is to, again, price correctly and price at a profit. It's not yet happening.
Yeah.
How about you, Sheel?
I also like businesses that make money. But I think aside from that, I think there still is an opportunity in better data. Better data, obviously it's buzzword of the years, but you actually can use it for customer targeting and for underwriting. And very few companies have yet done this effectively.
Are there any examples of companies you've seen that have, incorporated better data, applied better data?
Sure.
And what are examples that you could see in the future?
Sure. So some of these companies we're talking about that do coastal insurance think that they have better underwriting models. And it could be that your model is assessing somebody based on their zip code. And really it should be on a house level. Is there a mountain between you and the coast that is the big danger? You might be in the same zip code as somebody else, but with totally different risk. Right. And so there are companies doing that. In commercial, I saw a company that actually takes all this external data about a place, like Yelp and TripAdvisor pictures, and will assess whether your floor is slippery. I don't know if that works or not, but actually I talked to reinsurers And they say like the model really works, and I'm shocked by it, but hey, that's amazing if it does. So I think there are plenty of opportunities like this that we're in the early innings of. And then I just want my life to be easier. So I want to invest in things that make my life easier. And it's still too much of a pain in the ass to buy insurance, and I have to buy it all the time. So like it should be bundled in with other stuff, A, and then B, just like the experiences still aren't good enough. Like I'm still answering all these questions that I don't need to be answering. Like just pull the damn information from public records. Like why, like if I give you my address, there are all these data points about my house that you should already know. Why do I have to type that in? That's a waste of my time. So I think just like better product, direct to consumer, and with better data is like sort of the intersection of what I like to see.
What are the analogies for the types of big companies that can be built in insurance or are being built right now? Is it like an Expedia for an insurance? Is it like, what are the different types of?
So we operate a hybrid model. And the reason that we do that is, our product experience stays the same. The paper may be different. But we know that our customers are going to span the entire spectrum of high risk to preferred customers. So our bet is effectively, hey, like we have a very good understanding of who's competitive where, because we work with 30 carrier partners, and we also have a pretty good understanding of who's mispriced. Our objective is basically look at where the mispricings are, stand up a product to accommodate those particular customers, and make sure that they're happy when they come in through cover. There are certainly, like if you take a look at Lemonades and Roots, I mean, the general thesis is there is no future working with other insurance companies. It's going to have to be a full stack insurance company, or as close to that as possible to deliver the product experience that Sheel's describing. We'll see. I mean, like it's very possible that that's the case. And in that case, it's, the overarching goal of any InsureTech at this point is it should be build exceptional product and build exceptional customer service experiences around that product, and go from there. Because everything, like, after you make a request is very mechanical. It's just, money effectively. Yeah.
One thing we haven't talked about at all is health. And it's actually just a note. It's an entirely separate beast. Yeah. It's like so different,
and so policy linked.
And has a lot more to do with like negotiations with the providers and all this stuff that doesn't play into like what we're talking about is financial products. So that's why health is entirely out of this discussion.
And is it also out of discussion in the sense of you don't really look to invest in it?
No.
Too much of a beast. Oscar's already.
I have an investment in the health side, but it's not actually a health insurer. It's like a company that builds a SaaS tool for health insurers.
Yeah. What about pet insurance? Ben Matthews at Bessemer has been saying there's big opportunity in pet insurance. I hope I didn't blow up the spot.
Yeah. So it's there's Trupanion, there's Pets Best, there's a whole bunch of these guys that exist, and actually the margins are better than P&C, like traditional P&C, certainly. The future of that business is probably going to be tied to growing the market by linking the product to like employer benefits, direct to consumer pet insurance. And even point of sale pet insurance via veterinarians is pretty saturated. There is certainly money to be made, but even now, folks like Trupanion are accepting higher loss ratios, meaning they're lowering their prices to pick up, more of a relatively small market. But this is the generic theme here is specialty insurance. Jewelry is another one of these examples of incredibly high margin businesses. I'll give you an example. Jewelers Mutual, which does specialty jewelry insurance, runs at a loss ratio of something like 32 to 35% per year, meaning that for every dollar they pull in, they pay only 32 to 35 cents out in claims. And if you take a look at their expense ratio, which you alluded to earlier in this conversation, that's sitting at like 45 to 49%, meaning they're selling jewelry insurance from their yachts.
That I don't understand because your renters or homeowners insurance policy largely covers it.
I mean, they're like structural reasons for this. Like, so for example, if you got a renter's policy or homeowner's policy and you added like the personal articles footer for your jewelry and you made a claim, that's a ding against your homeowner's policy. Yeah. Right? If you make two claims against your homeowner's policy, there's basically no admitted insurance market in the United States that will take you. Right? And again, the average consumer has no idea that this is actually the case. But if you're going to go get a standalone policy, like a Jewelers Mutual policy, that's completely separate from your homeowners, and it won't adversely affect your rates. Again, stupid structural reasons for this stuff. They should be entirely decoupled. So it's certainly an opportunity, a specialty, but it's not how people actually think about getting insurance, right? Like, the reason that a big part of our business is auto insurance and then home insurance after that. The reason that we even focus on auto insurance is it tends to be the thing that people shop the most. And it makes a material part of their after-tax income on an annualized basis. Yeah. So they get auto insurance. And ideally you're picking up pretty good risks that are accumulated assets, like we are. And then you upsell to homeowners insurance. And as, people have kids, and they have, dependents, you get term life insurance. And then as they accumulate other exposure assets, you pick up umbrella. And like, that's the arc in insurance. That's why State Farm is what State Farm is. Starts off with auto, moves into the other stuff. But the specialty line stuff, jewelry, all that stuff tends to be sold at the end.
Yeah. There's this like notion that insurance is sold, not bought. That's actually not true for auto. Auto is bought and then the others.
And can you pack the sold, not bought with any of that?
Yeah. So people think that like insurance, like somebody has to come to your house and sell you this thing. It's not something like you go out and seek, but actually for auto, it is something that you go out and seek. Like it turns over relatively frequently. Home, like typically people buy it when they buy a home. It's mandated to get a mortgage and then often don't change unless they're in a coastal state, which they get kicked off or risk, or premium goes up significantly. So the average homeowner's insurance policy is like 6.5 years. Yeah.
Karn, can you unpack a little bit with Cover how you've thought about go to market? You talk a little bit about it, and how that evolved over time since you started to.
Yeah. So when we started, our initial hypothesis was that we'd be selling a lot more specialty and personal articles floaters than we actually ended up doing. It makes up about 20% of our business now, but the vast majority of it is auto and home. So what you'll see is, so we do direct to consumer. We acquire on our account. We don't buy leads. We don't do any of that. Folks will give us 360 views of their cars. They'll walk us around their houses to document their property, and then we will programmatically market them across the country. Mm. That is typically like the way that we enter is usually the vector of attack is predominantly auto and home. The responsiveness to other lines of business, people just tend not to care. And that's very true of term life insurance. That's very true of jewelry. That's very true of pets. The stylized example of term life, like you really only think about life insurance when you have a kid. Like that's really it. That window is super narrow, which makes CACs astronomically high, though it makes it relatively challenging if everyone's just considering, the entry point of that. And so now we've like shifted this to, shifted our model to being, hey, fine, we know what people buy from us. We want to make sure we deliver an exceptional customer experience so that when they're ready to be, when they're thinking about these other lines of business, we're the port of first call, right? So we sell a lot of auto and home. Eventually we'll sell term life because typically speaking, you're going to go back to the person you bought insurance from, by term life.
What are the most clever distribution strategies or customer acquisition strategies that you've seen startups?
I'll tell you about some of mine. If you go to driving.cover.com, this is one of a couple of these things. Like we generally speaking take a portfolio approach to go with. A lot of it's paid, but a lot of it is like actually building product and services that help build top of the funnel for us. So if you go to driving.cover.com, we actually built a virtual defensive driving school that we give away for free. So, and the impetus behind this is fairly straightforward. If you go to like defensive driving school, you're trying to do one thing. That is like, get rid of a ticket, like bring the price of your insurance down. You get like a 10% or 15% discount. And if you were to Google defensive driving school now, you'll see that these courses cost anywhere between like $49 and $150 to take. And it's largely just a pre-produced script that we give away for free now. And then apply that discount to folks who are actually interested in shopping for insurance. It's a crazy long story as to how this came about. But the crux of it is this. I basically put in a call to the regulatory body that handles defensive driving school and driver's ed in Texas and learned that there were 480,000 people in Texas that had taken a defensive driving course over the course of the last 18 months. That's a huge number of people who are searching for these types of courses. And as a technology company, we need to be focused on what are the things that we can give away for free as a technology company at scale, and offer value before we even ask for the insurance transaction to happen, right? Analogously, there are tons of reports that are run by insurance companies that are related to your driver history or your vehicle history. All of these things, again, should belong to the end customer because they're related to the end customer. Right. Why are they not just given away?
Yeah. What sort of new categories could you imagine emerging as things we insure in the future?
Yeah. I mean, I think like the typical one people talk about is drones. I tend to think it's not a big enough opportunity, but there can be a company built there. I don't think it's going to be a multi-billion-dollar company. There are a bunch of categories people talk about as like growing rapidly. So drones, maybe not be. Cyber insurance is one we have not covered at all in this podcast. So cyber insurance has grown tremendously, but from a really small base, and it's still actually just too small of a market.
Cyber, like if I get hacked?
Yeah. So really, it's not like if a big company gets hacked, which the crazy thing is this is happening all the fucking time. And
it's such an underpriced market. If you're in the market for cyber, you should just buy it. It's cheap no matter how you look at it.
Yeah, because one of my companies actually predicted the Marriott breach, which is kind of cool. Wow. It's called CyberRight. And they had sent a report out to a bunch of reinsurers with high risk companies, and they basically assessed the external risk of a company, and Marriott was like dark red risk. Wow. And this was like several months ago before it happened. So it's kind of cool.
I wonder if hackers look at that and be like,
yeah, there's an opportunity.
they caused the hack. So yeah, will there be insurance if I lose my Bitcoin private keys or like crypto?
Hacker consulting firm.
Yeah. So cyber, I think like will continue to grow, but I just think like we're starting from a small base. People don't adequately understand it. Yeah. And like Karn said, like we don't know how to price it.
Mm-hmm. Yeah. So the natural, you can't underprice you don't want to be underpricing an underpriced market to pick it up. I think it'll eventually become very clear that this is a thing that people need to buy, but prices will certainly rise.
And I think it'll factor into other parts of it won't just be selling cyber insurance for cyber insurance sake. It might be like a part of our homeowners insurance as well. Stuff like that.
In a world in which Augur or prediction markets or decentralized applications become mainstream, could we be insuring a lot more things? Is that possible? If the friction to...
Yeah. I don't know how much consumer behavior is going to change, right? Yeah. Like, you insure your home because it's like typically speaking, the most valuable thing that, you have a claim on. And you'd be remiss if you weren't covering it off. And then your car is like your second most valuable thing. And then you get term life insurance in case, God forbid, something happens to you and you need to cover off your kids, right?
Well, and then we didn't talk about your third most popular thing, which is the largest insurance product that has come out in our lifetimes. It's AppleCare.
Yeah.
So your smartphone, right? So there's a difference between warranty and insurance. Yeah. AppleCare is actually both, and actually, by the way, if you are an AppleCare user, you should switch to Jetty. I talked about renters insurance not being a great business, but actually Jetty covers everything that AppleCare covers and has you go to Apple for it, but it's cheaper. So if you're using AppleCare, just get Jetty renters insurance.
Or if you're using AppleCare, just go to Assurant, which is what AppleCare is. Apple's not internalizing that risk. So
if you were starting a company today in the insurance space and you'd had any set of skills you wanted, what company might you start?
It's a good question.
Or how would you approach it?
I might do something on the capital market side. So like we've talked about, there are a lot of companies attacking the distribution side of things. There are companies that are attacking distribution and a bit of underwriting, not much. It's unclear whether the underwriting is good enough yet. On the capital market side, a lot of the stuff that Karn was talking about earlier, like the industry structure, I think can be changed if somebody took a deeper look at the underwriting. And so one of the things could be, Karn was talking about, I think you mentioned Ledger. So Ledger is, if you think about how Lending Club is a way it was originally called peer-to-peer lending. An individual can buy your lending risk. So the same could be true in insurance, where like somebody could buy your insurance risk, but maybe not yours, but like a collection of people's. And so a marketplace could be set up where your insurance risk is sold to other people, and this could go on and on. So that's an opportunity I think still exists. It'd be very difficult to do, but I think could be done.
Yeah. I think, look, I'm still an ardent believer that if you own the customer, you own the lifeblood of the insurance business. And so, if you're trying to create a lot of value in this space very quickly, you should focus on distribution and underwriting. There are hundreds of admitted insurance companies in the United States that are low-key billion-dollar businesses that focus on a sliver, right, of a overall P&C market.
Yeah. To Karn's point, 49 of the Fortune 500 companies are insurers.
Wow.
we're direct to consumer, and we're personal lines specifically. So auto, home, and everything else you can take a picture of. Commercial, is even more broken than personal lines insurance is. And the margins tend to be higher, though the absolute, premium volumes tend to be lower. There are folks like MBroker who are sending up their own insurance products at this point. Obviously, Next Insurance has raised a gargantuan round to start building out commercial products. That's a relatively underreported on segment, I think, of the insurance space. So there's certainly opportunity there. But again, I think it's as a distributor and underwriter of that insurance, rather than trying to build on top of this mess that are incumbents in that space.
Yeah. For very talented technologists listening in who are trying to do something distribution or underwriting, or I guess what would be your sort of request for startups, or maybe your advice in terms of how to approach whether it's go-to-market or distribution or even getting started? Yeah.
So look, I think there's plenty of opportunity, whether it's distribution, underwriting, claims management, regulatory. There are all these discrete businesses, these discrete functions where you can create value. I think you're just going to have to figure out what plays best to your skill set. Certainly building sexy products in an unsexy space plays well to my skill set. But if you're thinking more in the enterprise, software sales type of frame of mind, then maybe standing up a TPA or something like a Snapsheet makes a lot more sense to you. And certainly there's a huge business to be built there. So again, play to your strengths, but there's opportunity across this entire value chain.
I think the insurers are increasingly hungry for innovation. So there's probably not an opportunity for multi-billion-dollar companies, but there are opportunities for lots of great companies in policy administration, claims management, all this kind of stuff.
Well, talking about policy administration, every single InsureTech that I know of has gone on to build their own custom.
You have to.
Administration. They look at software businesses like Guidewire, which is a multi-billion-dollar business, and this is garbage.
Yeah.
Right?
Guidewire was one of the first venture-backed success stories in insurance. It went public in 2001, and I think it was backed by NEA and some other.
So certainly an opportunity to build it out, but even then, what's the edge? What's your wedge into distributing that kind of product? The way that Guidewire distributes is through consultants like E&Y who have a vested interest in making sure that this terrible software, just terribly overpriced software, ends up in the hands of insurance executives. Again, it comes down to what game you want to play and how quickly you think you can ramp in what you're doing.
So looking out 5 years out, 10 years out, broader, how else do you expect the insurance industry to be disrupted?
Sure. So Sheel actually alluded to this earlier. I think it's going to be services driven or value added services driven, and insurance is going to become increasingly embedded in other products that technology businesses build and serve up to their customers. So if you can find a way to offer value to your customers and it makes sense to include insurance, it's probably how it's going to be done. Yeah. The second piece of this is, we talked about the 7 intermediaries between a dollar of risk being, bought and sold. Eventually that consolidates and it's going to be to the net benefit of the customer, meaning that of every dollar of premium that's taken in by an insurance entity, a larger part of that dollar will end up back in the hands of the customer, because these entities will be more efficient. And that net is a good thing, because a lot of insurance products you can view, from the perspective of them being a public utility or a public good. And I think that overall, that will have to happen over time.
Yeah, I'm excited to see more insurance embedded in everything. And I think, it makes no sense that we buy things separately from where we insure them. It should just be a lot easier process. And in general, I'm looking to make my life easier. So looking at when I buy something, just one click, add insurance. One of the most important things that I'm excited about in insurance is all of the companies that I've seen building product are all building product that's better for the consumer than what's out there right now. So
no doubt.
What exists is horrible, not only from a usability perspective, but actually the products themselves. So whole life insurance is a horrible financial product, and no startup that I've ever come across is selling whole life insurance. And so that makes me really happy. So the net result of all this is a better financial life for people. And that's cool.
Karn, let's close perhaps by shouting out our good friend Arjun Sethi, also board member of Cover. What's either your best Arjun story, or where has Arjun added the most value
So Arjun, as you know, is a, tried and tested operator VC. Mm-hmm. So if you ever, folks ever have an opportunity to work with him, he's going to give you the straight goods, no bullshit. That's his value add. And he's been part of our story since we started at a YC. Wrote one of the first seed checks into Cover, letter Series A, letter Series B. Man, I couldn't recommend him highly enough.
Yeah. Awesome.
Solid dude.
Excellent. Great way to close. For people who enjoy this conversation and want to follow you guys online and stay tuned with what's up with Cover, where can they do that, Sheel? Or any plugs?
At Pitdesi, Pitdesi on Twitter.
Perfect. And stay tuned for more podcast episodes with Sheel. Karn?
Oh yeah, so you can follow Cover at Cover, or myself.
Oh, that's great.
Yeah,
at
right?
Cover?
Right.
Man, that's great.
Yeah, we got it all. And at Karn Saroya
awesome.
On Twitter.
Guys, thank you so much for coming on the podcast. If you're an early stage entrepreneur, we'd love to hear from you. Please hit us up at villageglobal.vc/network catalyst.